Okay, you guys, I thought we'd go through some notes here for Chapter 5 before we get started with the videos and the videos of the problems and the homework problem. And let's just kind of bring this up as we go. Now, in Chapter 5, you guys, we're going to be dealing with a merchandising business rather than a service business. So far, we've just dealt with a service business. And in the first 4 chapters, you made it through those 9 steps in the accounting cycle. And then we were doing that for a corporation that was a service business. Well, here we're going to look at, in Chapter 5, it'll still be a corporation, but we're going to look at a merchandising business rather than a service business. Now, I'm sure you all know how they're different, but of course, a service business provides a service for a fee, and we called their revenue account fees earned. Here, though, a merchandising business, they don't provide a service for a fee, rather they sell a product. So we're going to call their revenue account sales. Now, a merchandising business doesn't make a product. That would be a manufacturing business, which we'll get into in the spring in managerial accounting if you come back to see how the book ends. I hope you do. But anyway, that's beside the point. A merchandising business buys a product for resale, and we'll call that inventory or merchandise inventory. And they usually sell it either to wholesale customers, which would be another business, or to retail customers. The reason that makes a difference for us in this chapter is we will charge retail customers sales tax. There's no sales tax charged to the wholesale customers. So, for example, when Coca-Cola sells Coke to Walmart, no sales tax. Walmart sells you or I a Coca-Cola, we get charged sales tax, if there's sales tax in that state. And, of course, there is here in North Carolina. Okay, a few things that we're going to do a little bit differently here in Chapter 5. I have some videos already made from the 12th edition of the textbook for Problem 5.1a and for Problem 5.2a. They're exactly like Problem 5.1a and Problem 5.2a in your edition, the 13th edition of the book. The only thing you'll hear me in the videos refer to the wrong page number some, but I'll have that noted below the video, so hopefully that won't be confusing. If you have any questions there, please get in touch with me, but I don't think you will. Also, instead of using the chart of accounts in your textbook that's on page 230, we're going to use one that I've developed, and you see it posted on the course website already. Your new edition of the textbook leaves out some accounts that I think are important for a merchandising business, so we're going to include them. And for that one, we're going to pick up a problem for the financial statements. We're going to pick up Problem 5-5A from the previous textbook, but I'll provide you with a PDF of it. And then the homework problem, I'll provide you with a PDF file that you can open through Acrobat for Problem 5-5B from the previous textbook as well, because there are some accounts there that I believe are important that are left out of your latest edition of your textbook. So just a few little changes there. I don't think you'll have any issues with them. If you do, please get in touch with me, and I think we can clear that up. But honestly, I don't believe there'll be a problem. Now, in looking at the merchandising business, you guys, a merchandising business would have those same 9 steps in the accounting cycle that a service business had. But we're not going to go through all 9 steps for a merchandising business. We're going to focus on the ones that would change or be significantly different than those of a service business. So we're going to look at some journal entries for a merchandising business. Now, of course, those journal entries would be posted, but we're not going to post to the ledger this time. We're just going to make the journal entries. We're going to look at some purchase transactions where the business is buying inventory. And we're going to look at some sales transactions where the business is selling inventory. Also, we're going to look at a set of financial statements for a merchandising business. And they're somewhat, as I mentioned earlier, and they're somewhat different as well. So we won't go through all 9 steps, but we will look at some journal entries and financial statements. Okay, let's go through these Chapter 5 notes. But before we do that, let's take a look at this chart of accounts. You've got the file listed there on your Moodle page. But let's look at it here. And I need to move this over a little. Okay, maybe move it a little bit more. Alright, there we go. Now, cash you're already familiar with, you guys. Accounts receivable. Here's a new account, merchandise inventory. That's just merchandise that the business has bought and they're holding for resale to customers. Again, either wholesale or retail customer. Office supplies and prepaid insurance you've seen. You've also seen land. We now have store equipment and office equipment. We'll have accumulated depreciation on both. You guys, I always tell students to think of store equipment as equipment needed to make sales. Things like cash registers, display cases, things we'd use out in the store. Cash registers is probably in scanning equipment for inventory to check people out and that kind of thing. It's probably the best example. Alright, then under liabilities, you've seen accounts payable and salaries payable. We've also worked with unearned rent and notes payable. A new one this chapter will be sales tax payable. You know, if we collect sales tax from a customer, it's not ours to keep as a business. We just have a fiduciary responsibility there. We're a go-between between the retail customer and the state. We have to send that into the state in a timely manner. Your stockholders' equity section looks the same. Let's come up here. It's where you're going to see some big changes. Under revenues, instead of fees earned, we'll call their revenue account sales for a merchandising business. Sales returns and allowances and sales discounts will be tracked separately, and they'll reduce the balance of sales on the income statement. Sales returns and allowances and sales discounts are actually contra revenue accounts. They'll increase on the debit side. Just like, remember, accumulated depreciation, store equipment, accumulated depreciation, office equipment are actually contra assets, which increase on the credit side. You have a new expense account, cost of merchandise sold. You guys, it's an asset, merchandise inventory, while we're still holding it and it hasn't been sold yet. Once it has been sold, we'll transfer its cost into the expense account, cost of merchandise sold. Sales salaries expense, advertising expense, depreciation expense, store equipment. Those you should all be fairly familiar with. Delivery expense and credit card expense, miscellaneous selling expense. Those are all of your selling expenses. Those are ones we can directly tie to making sales. Let's come back to a couple of those. Delivery expense, if we deliver merchandise that we've sold to a customer, whatever it cost us to deliver that would be debited to delivery expense. If we pay delivery charges though on a purchase, we'll add that to the cost of the inventory. You'll see how that works in the journal entries. Credit card expense, you guys, you might be familiar with this, you might not, but let's say, for instance, if you go to buy $100 worth of gas at a gas station, let's say you've got a really large tank, I guess. If you pay with a credit card, the gas station will only get about $98 out of that $100. The credit card company charges a fee to the store. It's usually about 2% for MasterCard and Visa. And that would be credit card expense for the business, that 2% there. We'll run into that sometimes, or you'll run into it in your journal entry problems. Then our other expenses here: office salaries expense, rent expense, depreciation expense on office equipment, insurance expense, office supplies expense, and miscellaneous administrative expense. Those are all administrative expenses. We're going to separate those out on the income statement this chapter. They call office equipment things like copiers, that kind of thing, equipment not used in the store itself, as an administrative expense. Store equipment, cash registers, that kind of thing used in making sales will be a selling expense. We also have other income. That's income or revenue from sources other than the principal activity of the business. Well, a merchandising business is not in the business of renting out buildings or earning interest like a bank. So any rent revenue or interest revenue would be other income for them. And then we're required on the income statement to show interest expense as a separate line item at the bottom. You guys, you can refer, in some of the videos, I'll say, okay, look on your chart of accounts. In the old textbook, it was on page 227. Refer to it in picking out some accounts to use, that kind of thing. You can refer to this one. All right, now let's go back to the Word document and go through a few more items. I think you'll find that this chapter is a little easier. The journal entries that we're making are kind of repetitive. The ones back in chapter 2 covered all various topics. These mainly deal with purchasing and selling of inventory. Now, a merchandising business would have all those other general transactions. We just don't look at them here in this chapter. Okay, when dealing with inventory purchases or sales, we're going to have some shipping terms. We just want to get straight with the shipping terms up front. Who's responsible for paying shipping charges, the buyer or the seller? And then and that's going to depend on who the goods belong to while they're in transit. Whoever the goods belong to in transit will be responsible for shipping charges, and they also bear the risk of loss in case there's an accident or something. Actually, business probably wouldn't bear that risk of loss. Instead, they purchase insurance on the freight. But the party that the goods belong to while they're in transit would have to pay for shipping and have to pay for that insurance. Now, the shipping terms are going to tell us who's responsible. If it's FOB shipping point, then the freight belongs to the buyer in transit. It changes hands as soon as it leaves its shipping point or the seller's place of business. It changes hands to the buyer. So therefore, the buyer assumes the risk of loss and responsibility for all shipping charges. They'd probably, though, not take that risk of loss. They'd probably insure the freight for a fairly low amount in case there is an accident. Okay, if the transaction, you'll see these terms, don't worry about FOB, it stands for free on board. That doesn't tell you anything really. You're looking for shipping point, means buyer pays. And you'll see these terms in the transactions for your journal entries. Okay, you could see FOB destination point. Freight belongs there to the seller in transit. It doesn't change hands to the buyer until the goods reach their destination. Therefore, the seller assumes the risk of loss or purchases insurance and responsibility for all shipping charges. Okay, credit terms. You can also see these. Now, if you don't see credit terms, that means we probably made the sale for cash that day or credit that day. We'll treat credit card sales just like cash sales. But if you see credit terms, then that means the purchase or sale of inventory was made on account. Otherwise, there wouldn't be credit terms. So if you see 1/10, that means a 1% discount is allowed by the seller if the buyer pays within 10 days. N/30 means if they don't pay within 10 days, the full amount's due in 30 days. These are just some examples. 2/10 means a 2% discount for the buyer. The seller's allowing a 2% discount for the buyer if they pay within 10 days. Otherwise, full amounts due in 60 days. And you can also run into this N/EOM. I'm not really a fan of that one. I think it's better to just tell the number of days. Anyway, N/EOM just means full amounts due by the end of the month. Again, you're going to see these quite often in your transactions. Two types of inventory cost systems. You guys, well, there's a periodic cost system. Let's bring this down. And a perpetual cost system. Under a periodic cost system, merchandise inventory is accounted for, as the name would suggest, periodically. And there's no cost of merchandise sold account in the general ledger. Rather, there are accounts in the general ledger for purchases, purchase discounts, purchase returns and allowances, and freight in. Then at the end of the fiscal year, by performing an inventory count, cost of merchandise can be sold using the following formula. We'd take the beginning merchandise inventory. It'd be 0 if we just started the business. Or if we hadn't just started the business, we would have counted inventory at the end of the previous year. And that would be our beginning merchandise inventory. We'd add to that net purchases, which is calculated by taking purchases minus purchase discounts minus purchase returns and allowances plus freight in. The shipping charges paid on the inventory we purchased. Alright, then from when we add together beginning merchandise inventory and net purchases, that's all we had available for sale. So that's the cost of merchandise available for sale. We'll subtract from that what we have left at the end of the year in merchandise inventory, and that gives us cost of merchandise sold. You guys, this is the older system. The only system in use when I took this class, or the only one we were taught 20 years ago. And still in use sometimes today. It's just not the better of the two systems. The system is very time consuming, and it provides managers with less information concerning inventory throughout the year. Anytime they want to know what cost of merchandise sold is through that date in the year, they'd have to do an inventory count. Anytime they want to reorder, you'd have to send someone around, look and see what we have on the shelves. If that's low, look and see what we have in the back. If it's low there, we'd put it on the reorder list. You can see how that would be incredibly time consuming. However, this system was the only cost-feasible system before computer scanning equipment made the perpetual cost system possible for a merchandiser. And we're going to use the perpetual system in this chapter. We'll talk about the periodic system some in chapter 6. When we look at inventory costing methods, it's the main one we'll look at, because with inventory costing, a lot of that's done by a computer if you're using a perpetual system. But anyway, we'll get to that in chapter 6. Here in chapter 5, we're going to use this perpetual cost system. Now here, the general ledger, merchandise inventory, and cost of merchandise sold accounts are updated each time merchandise inventory is purchased or sold. This system provides managers very accurate information concerning inventory and cost of merchandise sold on any given day. With a perpetual system, you guys, we should be able, like at a grocery store, to look up in the computer system and see, okay, we've got 6 bottles of Heinz ketchup on the left in the store. Okay, we could set it up where we get down to 4 bottles, then the Heinz ketchup automatically goes on the reorder list. So you can see how it's much less time consuming. You guys that uses that scanning equipment, you're familiar with it. When you check out at a store and they scan your items out, 2 purposes there. It rings up the sale at the sales price, so it records sales like we saw over here, but it also takes the item out of inventory and increases cost of merchandise sold. When the business gets items in the inventory, they scan it in, and that increases the inventory account. system is the most widely used today, and then again, it's the one we're going to focus on here in Chapter 5. Okay, you guys, I hope everything is clear about how we're going to operate here in this chapter. It's a little bit different, but I don't think you'll have any problems. If you do, please be in touch. And thanks a lot.